What if I told you that one of the largest financial empires in the world is almost completely invisible? That behind billions of trades, trillions of dollars in assets, and decisions that ripple across global markets, sits a private company so secretive that few people truly understand its inner workings? That company is Fidelity Investments, an $8 trillion powerhouse privately held and quietly shaping the modern financial world. How did a company founded in a small Boston office in the mid-20th century grow into a behemoth controlling more wealth than most governments? And why does its structure, its strategy, and its influence make even seasoned investors uneasy? Today, we're diving deep into the story of Fidelity, its rise, its innovations, its secrets, and the lessons it offers about wealth, power, and the invisible hand that guides global finance. The story begins in a period of dramatic change post-World War II. America was a nation on the rise, the economy was booming, consumer culture was exploding, and Americans were learning to embrace investing as a pathway to wealth. But the financial landscape was fragmented. Banks and brokerages were often regional, stock trading was largely inaccessible to the everyday person, and mutual funds, still a relatively new concept, were struggling to gain traction. Enter Edward C. Johnson II, a young man with an eye for opportunity and a deep understanding of the shifting financial currents. In 1946, he founded Fidelity Management and Research in Boston, not with the goal of controlling the world's money, but with the mission to make investing smarter, more accessible, and more profitable for ordinary Americans. It sounds almost quaint today, but in those early years, Fidelity was planting seeds that would grow into a global empire. Fidelity's early strategy was deceptively simple: combine rigorous research, disciplined investment strategies, and a commitment to customer service. Unlike many Wall Street firms of the time, Fidelity focused on mutual funds, pooling money from thousands of investors to buy shares in companies across the country. This allowed ordinary people to participate in the stock market with far less risk than buying individual stocks. By the 1960s, Fidelity was beginning to expand beyond Boston, establishing offices in New York and elsewhere. But what truly set Fidelity apart was its culture of privacy, control, and long-term thinking. While most financial institutions were publicly traded or beholden to outside shareholders, Fidelity remained entirely private, owned by the Johnson family. This decision would allow the company to take risks, innovate, and scale in ways its competitors could not. Fidelity's growth accelerated in the 1970s and 1980s. It became an early adopter of technology, introducing computerized trading systems before many other firms even considered the idea. The company also pioneered new products, including sector-specific mutual funds, retirement accounts, and eventually online brokerage services. By making investing simpler, faster, and more transparent, Fidelity attracted a wave of new clients from investors to institutional giants. A key moment came with the launch of the Fidelity Magellan Fund. Under the management of Peter Lynch in the late 1970s and 1980s, Magellan became one of the most successful mutual funds in history, averaging annual returns of over 29% at its peak. Lynch's ability to pick growth stocks combined with Fidelity's infrastructure turned ordinary investors into millionaires and Fidelity into a household name. But beyond the headlines, Fidelity was quietly building something far more powerful than a mutual fund company. A private financial empire capable of influencing markets, institutions, and policy, all while avoiding the scrutiny faced by publicly traded firms. No empire grows without facing crises. Fidelity encountered its share of challenges, from market crashes to regulatory pressures. In the 1987 stock market crash, Fidelity's Magellan Fund, along with many others, suffered massive losses. Yet, unlike publicly traded firms that faced shareholder pressure and panic, Fidelity weathered the storm privately, reinforcing its commitment to long-term strategies. The 1990s brought the dot-com boom and eventually the dot-com bust. Many mutual funds failed spectacularly, but Fidelity's cautious, research-driven approach allowed it to minimize exposure while still capitalizing on growth. Throughout these crises, one thing became clear: Fidelity's private structure was a shield. Decisions could be made for strategy, not optics. Risk could be taken for innovation, not quarterly profit reports. Fast forward to today, Fidelity manages over $8 trillion in assets, spanning mutual funds, retirement accounts, ETFs, brokerage services, and more. To put that in perspective, Fidelity's holdings exceed the GDP of most countries, and its influence touches nearly every corner of the global financial system. But how does a private company manage this level of power without drawing public scrutiny? The answer lies in transparency to clients, but opacity to outsiders. Unlike public corporations, Fidelity does not have to answer to shareholders or report quarterly earnings in excruciating detail. This allows it to innovate, invest, and adapt quietly, often staying steps ahead of competitors. Consider the rise of index funds, ETFs, and robo-advisors. Fidelity has embraced each of these trends, sometimes leading the charge, sometimes quietly integrating them into its vast portfolio. Its decisions influence pension funds, 401ks, endowments, and even governments, creating ripples across economies. The modern financial ecosystem now has parallels to Fidelity's model: private control, data-driven strategies, and the blending of technology with finance. Every market movement, every algorithmic trade, every retirement investment could in some way trace back to the systems Fidelity built decades ago. So what can we learn from Fidelity's story? Privacy as power. Being private has allowed Fidelity to think long-term, avoid market hysteria, and take risks that public companies cannot. In a world obsessed with quarterly results, the Johnson family demonstrates that privacy can be a strategic advantage. Innovation wins. From early computerized trading systems to online brokerage, Fidelity has adapted constantly, showing that technological innovation is critical in finance, not optional. Influence without exposure. Fidelity proves that you don't need a ticker symbol on the stock exchange to shape global markets. Knowledge, infrastructure, and scale can grant power far beyond public awareness. Fidelity's story is more than just a tale of wealth. It is a story about control, vision, and the unseen forces shaping our financial lives. For every investor who trusts their 401k to a Fidelity fund, for every retiree relying on its advice, this company represents both opportunity and the quiet weight of influence. In the end, Fidelity forces us to ask a question. In a world dominated by private giants, who really controls the flow of money and who decides the rules by which our financial futures are made? The next time you check your investments, remember, somewhere in Boston, a company with billions of data points, decades of strategy, and trillions under management is quietly guiding the path of global finance, largely unseen and often unchallenged and undeniably powerful. If you found this journey into the world of Fidelity insightful, hit subscribe, give this video a like, and share it with others who are curious about the hidden structures shaping our financial world. And remember, the more you understand about these private empires, the better prepared you are to navigate the markets, protect your wealth, and question the systems that shape our economic lives.